Technical Analysis edition. We are 15 minutes late, and for that I apologize. As always, it is due to technical difficulties. Please apologize on my behalf. My apologies on my behalf. I'm not the most techie guy out there. I understand a little bit about technology, but sometimes just things don't work the way it's planned. But yeah, look, we're here now, so let's just get moving. Welcome to Jason McIntosh. Thanks for rocking up, Jason. And please, let's just go through the disclaimer as we normally have to.
Yeah, welcome viewers. And again, yeah, IT, not much fun when it doesn't work, is it? Yeah, look, just a quick disclaimer to kick us off. Look, as always, this is general advice, doesn't take your personal situation into account. I'm from Motion Trader, Jason McIntosh from Motion Trader. I'm not part of Selfwealth, but I've come on this with Roger to talk to you in general about all things technical analysis. I operate under a license provided by Chartreuse Wealth Management, and you can see their license number on the screen in that top part of the disclaimer. So with all that said, let's jump back to Roger.
Thanks, Jason, and we appreciate your time as always. So what we're going to talk about today is sort of I would like to say risk management 102, right? Because we talked about risk management 101, and that was more about position sizing and things last week. This is a bit of a follow-on to that, and that's talking about stop losses, right? So where, how to calculate, where to position them, and things like that, right? So we're going to get straight into it because obviously we're a little bit behind. Please do welcome any questions in the chat box, and we'll get to them as best we can. All right. So feel free to send them through. The beauty about this series is that we've designed it a little bit for beginners as well, right? So it's more of a theory sort of in the first 4 to 6 weeks, more the theory around technical analysis. And then as we get a little less into the theory, we can start talking a little bit more and getting onto the charts a lot more. All right. And talking about, talking about patterns and all sorts of things coming up in the future series. So that's the most exciting part. But unfortunately, we have to go through the initial education around trading as well. I think it's super important. All right. So stop losses, Jason. Why is it essential to have an exit strategy? Why is it essential to have an exit strategy?
Oh, look, Rob, Roger, I think this is such a fascinating area, and I actually love all the theory. I think the theory is like understanding the process and the principles is what brings it all to life when you come to applying it. So I always say to people, take the time to understand the underlying principles behind whatever approach it is that you're following, and you can then just follow it a whole lot better and make it work a whole lot better for you. And look, I think what makes exit strategy so important is that we often put so much focus on what stocks to buy. There's often so much coverage about the stocks to buy, and selling often, to me, from what I observe from people, selling is often a bit of an afterthought. It's something which, like, we think, well, look, that looks like a good stock to buy, and it's like rush out and buy it. But when are you going to sell it? And people often don't think about that until much later down the track. But it's actually a really important thing to consider early on, because when you think about it, you don't make your money when you buy, you make it when you sell. So selling is a really, really important part of the process, but it's like it might be given, I don't know, I'm just making up a number, 10% of people's attention, and all that focus goes on to when to buy. But it's when you sell where you either make or lose money. So a really important thing to be aware of. And I'll tell you a quick story about why this exit strategy is so important. So this is back in my early days on the investment bank foreign exchange desk. So I think this story is probably from around 1993. And so I was a junior trader on the desk back then, and I was on the night desk. So I'd come in at around 4 o'clock in the afternoon and work through the night. And I remember coming in one day, and the foreign exchange desk is normally a place full of a lot of hustle and noise and activity, and if nothing much is happening in the market, it's often also quite jovial with the guys just kicking around, having a laugh. And so there's always a lot of stuff going on. And I've come in one day, and it's actually quite hushed. It's and it just didn't feel right. And I sat down and I look over at my boss and go, "Hey, what's what's going on? And she's just given me a bit of a nudge and gone, have a look in the Spot Aussie book. So this is an electronic book which has all the positions for the Aussie dollar trader. And I have a look in there, and the exact numbers are probably blurred a bit by time, but I recall it being something like having $100 million Aussie position and a $1 million loss in the P&L column. Now, this is 1993. This is huge. To lose $1 million now in a trading room would be a big deal. In 1993, well, it wasn't a good situation. And but look, the thing what happened here was this guy had his entry strategy, but he didn't control his risk and he didn't have an exit strategy. This is why I'm always harping on about how important exit strategy is. It's great to get in. It's great to have all these great entry triggers why we should buy. But what happens when it's not working? This is what the exit strategy is all about. So this guy wasn't at the bank the next week when I came in. It was actually his first, I think it was his first or second week on the job. And so he didn't have a stop loss strategy. He didn't have an exit strategy, but the bank did. And the bank's exit strategy was saying, see you later. And so if you don't have an exit strategy for your portfolio and your stocks, well, someone's probably going to have an exit strategy for you. So a really important thing, Rog, I think for everyone to take on board and really think about what will cause me to sell a stock in my portfolio. You've got to be able to answer that question. If you can't answer it, it's trouble waiting to happen.
Yeah, especially as a trader as well, like as a more active trader. And I think this is really important if you're just an everyday, every now and then investor, right? My question is, are you willing to see not an unrealized loss on your trading account and hold that throughout all its period and time? And while that might also be, might give you massive gains in the future if it's gone down a lot, are you willing to hold that unrealized loss? Because a lot of people can't stomach it, right? So I think being able to cut your losses earlier, if that's the case, or at least, take your profit, I think sometimes can be a much better strategy for people, especially if they're more of an active trader, right? So, okay, so there's obviously various type of ways to stop your loss, so to speak, or a stop loss, right? How do you calculate or set a trailing stop loss? I know one of the things you teach is a trailing stop loss. How do we calculate that, Jason?
Yeah, it's a really interesting point you just made earlier, though, about an unrealized loss, because I often hear people say that, look, a loss isn't a loss until you sell. So, and this is how a lot of people justify holding onto a losing position, because they'll say, well, I don't actually lose anything unless I sell. So I can be down 40%, but I haven't lost anything. But I don't think that's the right way to look at it. Your portfolio, your stock is worth what the market's prepared to pay for it today. And if the market's prepared to pay you 50% of what you bought, well, I've got to tell you, you're down 50%. You've got a 50% loss. It's what it's worth today, not what you bought it for, not what you eventually sell it for. It's worth what the market values it today. So I think it's a false security that can lead people into holding stocks much longer than they should. And then that's how you end up with stocks which are down 80, 90%, and still telling yourself, oh, but it's not really a loss because I haven't sold. Well, it is a loss. It's a real everyday 100% loss. So you want to make sure you don't put yourself in that situation where you've got to be trying to convince yourself this. And so like last week we were talking about a standard stop loss when you buy a position. So you buy a stock and you think, okay, where am I wrong? What happens? At what point am I going to say this trade isn't working and I should sell? So that was some of what we talked about last week. We talked about position sizing. We talked about deciding where you're wrong if you buy a stock and it's not working out. Now, what we want to talk about today, we want to take that forward to the next phase, because when we were talking about process a couple of weeks ago, we said there are two key questions everyone needs to ask themselves. It's, when do I sell a losing trade? That's what we spoke about last week, your initial stop loss. Then the other side to that is, when do I sell a winning trade? And this is where your trailing stop loss comes in. And a trailing stop loss it's It's the same principle as your initial stop loss, in that it's your exit strategy, but it's just working a little bit differently. And I think a trailing stop loss. It's really one of the most powerful strategies that any active investor can have, because what it is, it's really a combination of an offensive strategy with a defensive strategy. So the offensive side is letting a profit run. It's like you've got a stock and it's rising. You want to give it time to keep rising, and that's what the trailing stop is all about. It lets that position continue to run. And then the defensive side is, well, at some point, it's probably going, unless it gets taken over, of course, at some point it's going to hit a peak and it's going to roll over and start to decline. And we never know how big that decline is going to be. It could be short-lived. It could be a terminal decline. You just don't know. So that's what the defensive side is. It gets us out and it stops us riding a great profit all the way back down to maybe where we got in. And so there are three types of trailing stop that I want to talk through today, and three different ways that you can set these trailing stops up. So let me just share my screen here. So these are the common types. These are common trailing stops that people use. They use discretionary stops, and that's where you'll look at a chart and you'll go, look, I want to set my stop loss at a certain level for a particular reason. We'll have a look at that in a moment. And then you've got the percentage trailing stop, and you've got the ATR, or the average true range stop. Now, this is a type of stop which I use, which I'm going to go through in just in a couple of minutes. So let's just quickly run through these different types of stop. So first of all, actually for the discretionary stop, I'm going to share my charting screen for this one. We just talk through a chart. So, Rog, can you see my chart on the screen?
Affirmative. I can see it.
Excellent, because last week I started talking about something which wasn't there, so didn't want to make that mistake again. All right, so I've got a chart of 7 group holdings. I'm using this because it's a good current example of how you might use a discretionary stop. And what's interesting with this chart is that you can see the stocks in a big upward trend, which is quite contrary to what the overall ASX 200 or the All Ordinaries is doing, which has been stuck in a range for the last 6 months. So it just goes to show not every stock does what the market's doing. That's why it can be really beneficial to have these trend identification indicators, like what I'm using with my Motion Trader service. I'm using myself. Just simple things like moving averages and breakouts. So just going through this discretionary stop. So this is, I got a buy signal for seven group holdings back in November last year. I don't actually own this stock myself. I'm trading the small to mid end of the market. I didn't get this one, but it was one with my Motion Trader service. So we had the moving averages cross, the 50 and the 100 day, and then we had a breakout to a new high. So that was an entry trigger. Now let's say you're using a discretionary stop and say, look, I'll initially give this 10%. So let's just measure out 10% from a hypothetical buy point, and that would take us back to around this previous low, which is quite handy. So you might say, okay, I'm going to buy here at around $20, and I'm going to set my stop loss below this previous low, and that's my discretionary stop. Now, should the price rise, which it has, I can then reassess. So the price runs for a few weeks, then starts to go sideways, then runs again. Now, once we have a new confirmed low point, we can then raise that discretionary stop up to beneath the next set of lows. Then the same process continues. Stock runs, consolidates, rallies again. So then the stop can be moved up against underneath the next set of lows. We've got a sideways period, and then the stock starts rising again. Same thing, moving up the stop below previous low points. And that continues through to where we currently are, where we've had a rally, a consolidation, we've got a new low point, and it rallies again. So this sort of discretionary stop is based off using a series of higher lows and placing the stop below that. Common way of doing a discretionary stop loss. I've done this a lot of times over the years, and I'll still do this in certain situations. It can be a good way to find an exit point without having to do a whole lot of calculations, but it does help to have some understanding of chart structures and understanding how you can get a sequence of higher highs, higher lows, and using those as your exit. And now the next one I want to show you, it's let's go and have a look at this percentage-based trailing stop. Now this is another common one, and it's really easy to apply. So what we have here, we've got a chart of a stock which has been on the rise. It's a stock called Codan. I've taken this example from a little while ago, and I'm using a 20% trailing stop, and you can see this red line beneath the share price. This is the 20% trailing stop. So the idea behind this, and this is an easy one you can calculate yourself and you can apply to your own portfolio. It's simply a case of when you get your entry point, every time the stock makes a new high, you set your trailing stop 20% below the previous high point, and then makes another high and you're 20% below again. So you can see the trailing stop, it's hugging, not so much hugging, but it's staying a consistent distance away from the recent high, from the trade's high. Then you get a period where the trade moves sideways, and you can see the trailing stop moves sideways as well because there's been no new high registered. A new high is registered and the trailing stop jumps up again. So a really easy one to calculate, a really easy one to apply. Ultimately, the stock will come back and trigger the stop, and that's the end of the trade. Now, sometimes the stock will continue falling, as it did in this situation. So the trailing stop has been really beneficial. It's locked in a big gain. It's given back some at the end, because that's what a trailing stop will do. It will always give back some at the end. It never gets you out at the high. That's not the point. The point is to stay with these large trends while they're running, but then to have that escape path when the trend ultimately turns. They don't work with precision. Sometimes like you can see this move here, it came really close to the stop loss, but the market rallied again. It could have gone a little bit closer, triggered the stop, and then started rallying again. That can be frustrating. A trailing stop doesn't keep you in all the time to get the best possible exit point. Sometimes it gets you out early. And some people will say, look, well, it's not that effective if it doesn't always keep you in. But the point I always make with a trailing stop is, it's not the stocks that come back and trigger your stop early and then rally which cause you the problem. It's the ones that start to fall and continue to fall when you don't have a trailing stop or an exit strategy in place. They're the ones that can really, really do a lot of damage to your portfolio. Now, the next one I want to look at, now I was talking about the third type, and this is the most interesting. It's the ATR, or the average true range stock. Now, this is one I use. I use with my motion trader service. I use with my motion trader portfolio, which I run myself. This is the one where I've got that $1 million or so portfolio. I'm using the ATR as the basis for my exit strategy. And so let me just take you through this one. This one, there's a little bit more to it. So we'll just work through an example. So this is a chart of share price graph of zip code. So I've taken this from a couple of years ago, this trade. But I'm using this specific example because it provides a really good graphic demonstration of how these ATR stops work. So I've got an entry point here. So this was a real signal that was sent out to members of my motion trader service. So using the moving averages and the breakouts as our entry. And then once we've got the entry done, then we jump over to the trailing stop. We jump over to the exit strategy. So you can see the line beneath. That's a trailing stop. Now, it's a little bit different. Actually, it's quite a bit different to the previous example, where you might remember, let me just quickly jump back to it. See how the trailing stop remains 20% below the whole time? The gap never widens, it never narrows, it's always that uniform 20%. Now have a look at this one again, and you'll see that sometimes it's relatively close, other times it's quite a fair way away. And you might go, well, look, why is that? Why is his trailing stop always got a different width? And this is the beauty of the ATR strategy. The ATR strategy, it's a dynamic trailing stop, and it's adjusting to the price action that we're seeing in the individual stock. Now, This one involves a few calculations. It's not quite as simple as the percentage one to apply, but if you can apply one like this, it can really help you tailor a stop to a particular stock. So the way it works is, the way my one works, the way I apply an ATR stop is I'm getting the last 30 days worth of trading data, and I'm getting an average trading range. So that's the ATR, that's the average true range. I'm getting the average true range over the last 30 days. And then I'm multiplying that by 10. And then that becomes the width of the stop. So I get the trade's high point and I'll deduct whatever that calculation gives me. The average trading range multiplied by 10, deduct that from the trade's high. So it's a dynamic number which is always evolving with the stock's volatility. So you look at this example of Zipco, and as the stock becomes more volatile during this strong trending period, the trading ranges are becoming wider, and that's why the stop is getting further away. So at this point, from the high to the stop, it's 52%. And some people say, hey, that's way too much. I could never have a stop that far away. But the whole point is staying with a medium-term upward trend and giving the stock an appropriate room to move. So everything I do is back tested. It's not just, well, I'll just use a number. It's done this way for a reason, because over time, when you back test volatile stocks and quiet stocks, you can see there's certain patterns of price movement. And now as time goes on, the ranges start to narrow, and you can see the trailing stop comes into a width of 35%. And even though in this period here, even though the stock hasn't made a new high, the trailing stop starts to tighten, and that's because the ranges are becoming narrower. It's not necessary to have this wide 52% stop. So the ranges narrow, the stop comes in, then we get volatile again, the ranges blow out, and then it starts to come in again. And you've got this constant process of giving volatile stocks room to move, and when they quieten down, reeling that stop in, making it a little bit closer. And this is what can help stay. And this can be done if you're a swing trader and you're looking for moves over 2 weeks to a month or so, you can use a trailing stop, but you'd probably have a closer one. You'd be using different parameters, but the same principles apply for short term, medium term, long term. It all still works. It's just understanding the principles and then applying the right type of parameters to suit what you're trying to do. Now, just to give you one more, I've got one more chart for you in this series. Now, remember I'd said some people would say, look, this is crazy. Why do you have a 52% trailing stop? Just 25% would be fine. Just use a 25%. And I'll show you what happens. This is why I like the volatility adjusted stops. Say you were to apply a 25% trailing stop to this particular stock. You can see the trailing stop. It hugs a lot closer to the share price, and it hits an exit point. Now, if you remember back to that previous chart, quickly zip back to it, this continues all the way along, remains in the trade, whereas our percentage one is getting us out a lot earlier because it doesn't adjust. It's just stock standard. It'll be the same for a property trust as it is for a volatile IT-orientated stock which doesn't make a profit. It's that's why I like these ATR, these dynamic stops, because they adjust. It's not the same for everything. And so look, that's a little bit of information on these trailing stops. And I think it's really important to find the right type that suits what you're trying to do. And it can really help you stay with these good trends and have an appropriate width, give an appropriate room to move for each situation.
That's great, Jason. I think I've got a million questions just myself, but you know what? You've shared with us three great strategies to get out of a position, whether you're in profit or loss. And I think this lends to next week's topic, actually, where we'll talk a little bit more around market structure and how to identify those higher highs and higher lows for people. All right, because obviously a lot of these stops are based off the highs, and people might not understand what to look for, right? But off that, there's a great question that actually come in last week, and it's also topical now with what you've just talked about. So when we hit a stop loss, all right, do you get out in the intraday price action, or are you waiting for are you waiting for the close price at the end of the day? Where do you get out? in the morning? I think you know what I'm asking. Is
Yeah,
it
yeah.
intraday or is it at the end of the day? When do you get out?
Yeah, I think it's a really, really good question. It's one which I actually get quite a lot. It's so say you've set your stop loss at $1, and during the day the share price of the stock dips down to 95 cents, but then closes the day at $1.05. So should you sell? Should you hold? How does that work? And now either way works. There's no right or wrong here. It can depend a bit on the situation that you're involved with, which I'll get to in a moment. But either way works. So the advantage of using a close, the closing method. So you need the stock to close below the stop loss to trigger an exit. The advantage of that is that in the situation where a stock does dip below the stop loss during the day and then closes above, well, you stay in the trade. And then sometimes, and you might find that the next day it's up again, then it's up again, and that was some sort of just a low point, and the trend continues. So you've stayed in a trade which otherwise you might have exited had you been using the intraday method. Like if the stop triggers during the day, you would have sold. So then you're out. You don't stay in for the recovery. The disadvantage of using a closing basis for your exits is that a stock may, so say you've got your stop loss at $1, it triggers at $1 during the day, gets down to 95 cents, gets to 90 cents, and then it collapses and it's trading at 50 cents. And you look at it that afternoon and go, well, I'm waiting for the close. It's now closed at 50 cents. So you've got quite a bit of what we call slippage between where your stop loss, where you thought you were getting out, and where you're going to be getting out. So that's a risk factor that has to be considered. Doesn't mean you shouldn't use a closing basis because of that, but you just got to be aware that that's a possibility. And it's happened to me before, where I've looked at a stock on the close and gone, well, I wish I'd gotten out when it triggered in the middle of the day, because now it's down 30 or 40%. But for me, it'll be like one stock within a much larger portfolio. So for me, that risk might be like 1 or 2% of capital. So I might be prepared to do that, and I am. I often work. Well, I do work I'll sell my stocks the next day if it hits a stop during the day. But if I'm using leverage, this is where I think the intraday hit is the way to go if you're using leverage. Now, Selfwealth doesn't use leverage. You can't do CFDs or futures through Selfwealth, but some people might buy a leverage ETF through Selfwealth, like through the Selfwealth buying a US stock. You can get a triple leverage NASDAQ ETF, for instance, and so you can get these products which can move around quite a bit. And the thing with leverage is that it can quickly spiral out of control. So if I'm trading a CFD or a futures contract and it hits my level, I'm out. I'm not waiting for the close of the day. I'll just get out. I'll use the intraday hit will be enough for me to exit that position. But if it's because I need to control my risk, I need to control that loss. I can't wait and just see if it comes back. But if it's an unleveraged stock portfolio, I've got a big diversification. It's not a huge portion of capital in any one stock. Then I'll probably be more. I'd be happy to go with see what happens at the close and adjust the position the next day. So you've got to tailor it to what you're doing.
Yeah, and I think once again that will always go down to your trading plan. So you choose a method and sort of stick to it consistently is important. And based on the number of stocks that you've got in your portfolio, as long as you know that that's a small percentage of loss, then you choose based on your capital and based on your trading plan, right? That's why I think it's super important to have that trading plan, isn't it? Okay, so we've got let's go to a couple of questions here. First of all, this is an easy one, Jason. What are the two EMAs you're using on your chart there?
Oh, sorry, I missed the question. What was the question?
What are the two EMAs on your chart?
I use I'm using the 50 and the 100-day exponential moving averages. They're not magic numbers by any means. I find they work well for medium-term trend following. That's what I do for a lot of my trading. It's and that's what I do with my motion trader service. It's medium-term trend following. I could use 10 and 20 days, for instance. That'd be more responsive to the price action, but I'll get a lot more signals. I'll get more false signals. Not necessarily a bad thing. That can all be managed, but I don't want to be too active through the day, through the week. I want to take that more medium-term active investing approach rather than more of an active trading approach, which is shifts the time frame a little bit maybe shorter term. But yeah, look, it's about finding the moving average combination which suits what you're trying to achieve, and they've got their advantages and disadvantages. Shorter moving averages give you earlier signals, but you get more signals and more false signals. The longer moving averages, you've got to wait a little bit longer to get the signal, but you may have more potential of that signal becoming more enduring and then staying to run. So it depends what you're trying to achieve.
Yeah, and off the back of that question, what's your opinions of moving averages as a trailing stop? You mentioned it at the start. So
yeah, really, really good question. And this was something I was planning on touching on in a little bit. And I will touch on this a little bit more later on. Got an example, but I think a moving average can be an easy to calculate and easy to apply stop loss. And I'll show you an example in a little bit when we go a little bit further into some of the topics we're discussing. But in general, I'd say, yeah, look, definitely consider using a moving average for a stop loss, for a trailing stop.
All right. Okay, fantastic. And we've got a question here. Where do you get your trailing stop loss data from? Just as an amateur, before you answer that one, Jason, there's a great indicator if you ever use TradingView charts. It's called trailing percentage stop. So that will give you a similar indicator thing that you can actually set the percentage, and it will base it off certain variables that you can set, but you can base it off the high, the last high. So I use that personally, and I know, Jason, you use other tools that you can get. You know what they are? What are they? Where do you get trailing stop?
Look, you just do a Google search for ASX data, and I think you'll find lots of data suppliers around where you can get that daily high-low close information. It's calculating using data to do the ATR based stop. You also need the software to do it. It's not just a matter of having the data. It's like there are a lot of calculations in doing that. So I wouldn't try to do an ATR stop by hand with my calculator. It goes through my trading software, and it just I tell it how I want it to do it, what the parameters are, that I'm using a multiple of 10 times the 1 month average trading range, and it will do it for me over a whole stack of stocks in no time. But if I tried to do it by hand, it'd be like go mad. So that in that situation, then I'd be using it. If I was doing it just by if I didn't have that facility, I'd be using a discretionary stop, or I'd be using a percentage stop, because they're easier to apply. But if you got the data, which is easy to get, and it's cheap, and you get the software, well, then you can do those more complex trailing stop strategies, which do use ATRs.
Yeah. And like I said, if you do want to use TradingView, it's there, and a lot of the indicators are free as well. And that's one of the charts, one of the softwares that you use as well, isn't it, Jason? To show a lot of your examples.
Yeah, TradingView is great. I had TradingView up just a little while ago when I had that 7 holdings chart. That's TradingView. I use TradingView every day. And it's a great resource. It's inexpensive. Gives you charts from around the world, stocks and currencies and metals and all sorts of things. You can call up. Look, there's so many things. You can get bond markets. It's amazing the depth of data they have. It's when I left the investment banking world in 1999, it would cost something like that would have been inhibitively expensive. It just wouldn't have been feasible for someone to be based at home and getting that type of service. But what we have now is just extraordinary. So if you're looking for a charting service, have a look at TradingView. Really like it. And as Roger, as you were saying, it's got some really good indicators like the trailing stop sort of functions you can get get engaged, and well worth having a bit of a play around with.
Yeah, the Selfwealth platform also has some advanced charting now, which you can go in, and if you just want the basic sort of advanced style of charting, you can go in and have a look at that as well. So it's just under stock details, and there's, you know, if you're a beginner, then that might be suited to you as well, because it's all within that one platform, right? The beauty, I mean, don't forget, this is brought to you by Selfwealth. So please like and subscribe on our channel, obviously. This great education that we love giving to you all. So if that would help, if you did that. And at the same time, we're talking about stop losses and understanding that the Selfwealth platform also has a stop loss functionality. But it's really important to understand. I'll just quickly steal some time here, because a lot of these questions are coming around stop losses on our platform, right? It's important to understand that with a stop loss that you would set on Selfwealth. So we're going back to that question about whether it happens in the intraday or whether it happens at the end of day. If you were to set a stop loss on our platform, it happens in the intraday effectively. All right. So I don't want to get too much into it technically, but if you set a stop loss, what will happen is as soon as that price gets hit, your order will get sent in the market to try and get filled. All right. So it's not like Jason has explained how he would wait potentially in a physical cash equities market. He'd wait for that end of day price and then risk potentially a bigger gap down on that. And then he could sell it the next day, the following day, whatever market depth there's available, right? What will happen is if you set a stop loss with our platform, it will give you an intraday stop loss. So it will get triggered and then it will try and send your order into the market to get filled, all right? That's the other thing that you got to be conscious of. A lot of people come and go, expect it to be filled instantly, all right? I get that, the stop loss. If it's an illiquid stock, you have to understand that sometimes that order that gets sent in the market won't just get filled instantly. So yeah, going onto that functionality where people expect things to happen instantly. Sometimes your order won't get filled instantly, and it may take a bit to get filled, right? So I just wanted to put that in so people do understand how the stop loss functionality works on our platform. All right. All right, Jason, there's a question here. How do you manage, say, CXO, which had SPP, had a share purchase plan at nearly 50% discount to the prevailing stock price? I don't know if this is a question.
Yeah. So to just run that through again, how do you
manage, say, CXO? So maybe you can bring the CXO chart up.
Okay, so core lithium, yeah.
Yeah, which had a SPP, so I'm assuming share purchase plan, at nearly 50% discount to the prevailing stock price.
Yeah, that's an interesting one. Okay, well let's actually get a chart up. We'll just talk through it on the chart. So I'm going to share my screen for this one, and I'll get a chart of CXO up. Right. Okay, Roger, you can see core lithium on the screen?
I can see it, no problems.
Yeah, okay. So I don't know where the share purchase price has been. I don't know what the share purchase price is. So the way I handle SPPs is I actually wait until close to the closing date, and I'll assess what is the trend in this stock and where is the purchase price relative to the market price. So, for example, I don't know where core lithium's where the share purchase plan has been set, but let's just say it was set at 50 cents, and say it was closing at the end of the week. I don't know when it's closing either. But say it was set for 50 cents at the end of the week. I'd look at the current price down at 37. I'd see that it was a 50% share purchase plan, and I'd go, well, why would I want to buy this? It's the stock is trading below its moving averages. Again, I've got the 50 and the 100 day trading below the averages. It's below the entry price for the SPP. It'd be cheaper to buy it on market. I wouldn't want to do it. If the SPP was set at 35 cents and we're currently trading at 36 cents, I'd still be hesitant to take it up, because I'd still look at this chart and say, look, there is a downtrend. And what's not to say that next week the shares aren't going to have another drop and then be down at 25 cents, and I would have bought into a share purchase plan at 35. So I prefer to do share purchase plans when the share price is going in the other direction. When you've got a rising trend, when you've got the stock trading above the moving averages, and say back at this point last year in 2022, when the shares were at 90 cents, if they announced a share purchase plan at 80 cents, I'd be more inclined to buy into that. I'd wait until the closing date, see where the price is. So, okay, the price is currently trading above 80 cents. Yeah, I want to get as much exposure as I can at that, because I'm trading with the trend. I'm not buying something which is in decline. I think the risk then is higher. I think it's a higher risk play to be participating in an SPP when the share price is trending lower and is potentially below the issue price. So that's just me. Everyone else will do what they want. I let a lot of share purchase plans go to the recycling bin for this very reason. But then there are a few which I want to participate in, and a few I've done really well in because I've bought into an upward trend and I just get a bigger stake at a discounted price. So it's a case-by-case situation, I think, when you're looking at these things.
Yeah, good response. I think case by case as well. So some of the comments at the start were great, because it's just amazing to see different people using different strategies, right? Like Shannon was using a 50-day EMA and 2 closes after, which you can just touch on soon. Kirby was using ATR and moving averages in combination with pivot points, so very experienced. And then it's really good seeing everyone use their own examples. I'd love to be able to spend hours on this. Hassan, great idea. We do need we need a video on liquidity and being able to explain to people market depth. I think that's really important. It touches a bit on fundamental side of things, but it's also important to see how the markets trade, and sometimes people don't understand why their order hasn't been filled 100%, right? So it's important we probably talk a little bit about that. We've got what do you think of the XRF example? Let's have a look at the XRF example, and maybe you can tie in your we want to talk about other trailing stops. You were talking about that moving average. Maybe if we can tie that in, just conscious of time, Jason, maybe we can look at that on the XRF example.
Yeah, is XRF another share purchase plan?
No, not that I know of.
So okay, let's have a look at XRF. Now, what's the context of looking at this one?
He just wants to know, what do you think of the XRF as an example?
Okay.
Maybe you can use that as you were talking about moving averages. You wanted to bring up moving averages as a trailing stop. Maybe we could also.
So XRF is XRF's a motion trader stock. This is one I've actually got this one in my own portfolio as well. Look, interesting one. Like, I look back. First thing I look at when I call up these charts, first thing I look at is I want to see what the moving averages are doing, where the share price is in relation to it. So the moving averages crossed back in August 2022. I don't remember when I bought this stock myself. I would have bought it sometime during this upward trending phase, depending on when I had capital available, or when the stock triggered for me. But just looking at this chart, the first buying point would have been when it broke to a new high with the positive moving averages in September last year, and then we would have set a trailing stop. Now, we're talking about moving averages. Can you use a moving average as a stop? And you can. Like, you could use, now this depends on what time frame you're going to use. You might use a 20-day moving average, or a 50-day, or a 100-day. It depends what time frame we're trying to trade over. If you're trying to trade a move over the next 4 weeks, well, you probably wouldn't be using the 100-day. You might be using a 20-day moving average. But if you're looking for those medium-term trends, well, maybe a 100-day could be helpful. So with XRF, have we been using a 100-day? Well, if this was our buying point, it did trade below the 100-day here, so there could have been an exit. but then we get another entry signal as it breaks to a new high. Now, on this occasion, the stock runs quite nicely, all the while staying above the 100-day moving average. Stays above the 50-day moving average as well for the most part. If you're using on a closing basis, maybe it would have stayed in during a couple of these periods where it gets pretty close. But if you're using the 100-day, well, then your exit point would have been in January, and you capture a really nice move. So from, say, 75 cents up to $1.12. So what is that? That's roughly a 50% move over say 4 months, 3-4 months. So that can be done using that moving average. Now, the disadvantage of the moving average approach is that it will often exit during sideways consolidations, which this stock is currently doing. It's moving sideways. As it moves sideways, it usually will crash into those moving averages, and that can be okay if you're using that ATR stop. Actually, let me. Actually, I won't do that at the moment. If you're using the ATR stop, it's probably tracking up underneath the share price still, as it is with I've still got the position. My motion trader trailing stop is lower, so it's holding in this stock at the moment through the consolidation, whereas the moving average is out. So if the stock starts to rally again, the moving average one is out, but the ATR one, or even a percentage one potentially, is still in. What I think of this stock now, I think the upward trend remains in place. It's currently dipping below the moving averages, which is a point of vulnerability, but the moving averages haven't crossed to turn lower yet. So at the moment, I'd be giving this the benefit of the doubt and saying this is a sideways consolidation. It's pretty much bounded up within this range, so it's a sideways move. Should the share price start to break down below the low point from August, so breaking below a previous low. So we're going to talk about support and resistance another day, but we could draw in. Just looking this by eye now. Look at this. So this is a support, currently a support. So it picks up these previous highs, picks up the low from June this year, picks up the low from August. So if the price were to break below this support, well, then I'd be concerned that maybe it would start to unravel, and by which time the moving averages would have rolled over, they would have crossed, and I'd be saying, look, I think it's time to be getting out of this stock, because we don't want to sit in and potentially ride it all the way down, like CXO. Like, just remembering this CXO example, this was a great stock for during 2021, 2022. But then it did peak, the moving averages did cross. That's when it became really vulnerable. And there's been no reason to buy this stock since the moving averages turned lower in December last year. It got above the averages there in May, but the moving averages never crossed if you're using those longer term moving averages. I spoke earlier about if you're using 10 and 20 day, well, these would have crossed and you would have got a full signal to buy. Not necessarily a bad thing, but it's just, as I was saying, prone to more signals, more false signals. But the longer moving averages have kept you out of this stock all the way and kept you out of a complete debacle. Couple that with your ATR-based trailing stop, which probably would have got you out long before all the damage was done. So XRF we were looking at, that's it. XRF, at the moment, we're in the trading range, but I'll be watching support and I'll be watching what these moving averages do, and I'm wary of a breakdown, which would trigger an exit.
No worries. I think we'll just finish off with one more, just a clarification on that SPP question. There's another question there around the 5% open close, but we'll deal with that one next week, I think, Jace, because it's sort of talking about where to enter a trade versus sort of where to exit maybe. So the question from Ken was, the question was, when you are a holder but SPP, but with the SPP you lose 50% of your stake, do you get out or hold? I think
core lithium, I wouldn't, as I was just saying, I wouldn't be in core lithium at this point in time, because the trend's been down for many months. That's why this is, I keep, as I say, I harp on about this all the time because it's so important. You need to have an exit strategy. It's like you look at that core lithium chart and the question has to be asked, why would somebody be in that stock once it's already down 50% from its previous highs? It's like, I just don't think there was a good reason to be in it. People tell me, look, it's got this great fundamental story, and that it may have, but I'm not going to argue with the share price. If the trend is down, the trend is down. It might be a great story, but it might be a great story for 2 years, 5 years' time. I don't know. I don't want to argue with the trend. I don't want to stand in front of the trend. I'd want to cut my losses before I'm in a situation where I'm down 50%. Things happen. You get stuck in stocks sometimes, but I think a mistake a lot of people make is they get into these dire situations, and like with CXO, someone might be tempted to say, well, look, I'll take up the SPP and I'll average down. And that's all well and good if the share price stabilizes and starts going up. But what if it doesn't? What if there's some material issue with the company which we don't currently understand? I'm not saying there is. I know nothing about core lithium other than they have something to do with lithium. But you get these situations where it's like the share price is in a tailspin for a reason, and we may not be fully across that reason. Some stocks get bowled at the stumps and they're delisted. I stress, I'm not saying core lithium is going to do that. I don't know. But these are the risks we're dealing with. This is why I'd be so hesitant to average down into a stock which is falling apart, because I don't understand what's going on. Who knows something that what does somebody know that I don't know? What don't I get? So rather than trying to figure it out, I just say, look, someone else can have my shares, and if it comes good later on, well, then I might get back in. But for now, it's too hard. I don't want to play. And don't put yourself in that position where you're down a lot and you're then emotionally like, should I double up? What should I do? Because then it becomes really hard, and you end up missing great opportunities because you're struggling with stock which has really done some damage to your portfolio.
Yeah, it's good advice, Jason. But obviously, please be aware, this none that we talk about is personal advice. It's all general in nature, and it's just for educational purposes, right? We're not saying for you to go sell anything or buy anything, right? You've got to do your own research. You've got to do your own due diligence, and I think that's also a question that sort of mixes the fundamental story, as you said, with the technical way of trading, right? So if you've got something that you love about a company, or that's why you've got on the share purchase plan, right? Potentially because you like the company, right? And you can get stocks at a cheaper price, right? But that sort of mixes the two, and you've got to work out what you want to do around that situation, right, when it happens. So, but great advice, Jason. I think we'll leave it at that for today. Next week we're going to talk about market structure and how to identify those trends and consolidation periods. You've just touched on it a little bit with the XRF example, and it's going to be great because now we're going to start really diving into those charts and getting more technical if we can't get already more technical, right? So please like and subscribe. You can always ask Jason questions on his methods of finding out, through his website or through his channel. But other than that, Jace, I appreciate your time today. Sorry for being late, everyone.
Yeah. Oh, look, it's been a lot of fun. Been a lot of fun, Rog. And yeah, viewers, let us know the stocks you're looking at, the stocks you're thinking about, and let's have a look at a few of them and put the moving averages on and talk about them and some of the other indicators which I look at. It's that's what we're here for. We're here to make it interesting, here to apply a process, apply technical analysis and help you learn how I'd look at it and how I'd assess it. And like, I don't have the magic answer to everything, of course, but it's interesting to consider ideas, consider possibilities, and hopefully we can help you do a bit of that.
Fantastic, Jace. You have a great week ahead, and same to everyone else. And thank you for attending, everyone. And we'll speak to you next week.
Thank you.
Thanks, guys. Bye-bye.